Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to share with you again two different stocks that could potentially be undervalued at the moment. But before I do that, I want to talk about a couple of things. I want to make a correction. I did a video yesterday where I think I made a mistake because I've talked about two companies, and one of the companies was Qualcomm. Qualcomm has the growth estimates for next year, and the growth estimate for the next 5 years were wrong. I do use formulas here and extract data from another sheet, and I think they were basically this information here came from the wrong cells, because that's not what Qualcomm, basically what we expect of Qualcomm to grow in terms of earnings next couple of years. So I want to make that correction. So this is what it should look like. So if you go to Yahoo Finance and the analyst, you will see current year, the company is expected to basically make a loss of 25%. So basically it's slightly down 25%, right? Next year is 21%. Okay. And then the following 5 years, roughly about 7%. Again, remember, this is estimation. These people that doing these analysts here are basically using their own best judgment, if you like, to kind of predict this. You will see this slightly in other websites. They might have slightly something different. So for example, if you go to Seeking Alpha, you can see the year-on-year growth in terms of earnings. Okay, in terms of EPS, you will see it's about minus 25%, which is basically what we see here, minus 25%, right? And then it's almost 24%, 23.9. They've got it here, 21.6. And then the following year is minus 4.5. So they do it yearly. They don't actually basically combine the next 5 years and give you an average. So Seeking Alpha has that information in there, but you can see how many people we're looking. So the 25 and the 28 is the basically next 2 years, this year, next year. So I would say these two are more accurate. This one is probably some accurate because accuracy there because of 9 people have looked at that. But the rest of that is just only 2 people here. So again, we don't know how many people have done this. Okay, but either way, whatever happens, you will see obviously a decline in their basically in their earnings next couple of years, and also in the revenue as well. So minus almost 14%, then for up about 14%. Then almost a flat for the next year, and then the year after about 5% growth, and then it starts growing back again. So that is the correction I wanted to make. So apologies for that. When I actually did the video, I was watching it back last night, and then I realized that there was a mistake there. So apologies. Right, before I talk about the two companies I want to talk about today, I just want to talk about couple of other things. I was just updating my own spreadsheet. So I have my own spreadsheet here. Okay. Oops, something's gone wrong. Right, now zoomed out of it. Right, so what is happening here is I'll just do an update on this, because what I normally tend to do is after I finish, after I just make some buys, whatever, or sales, I'll go on my spreadsheet and update this, okay, according to what I have in here. Okay, so that helps me to kind of track everything. And I was looking at this and I was thinking, okay, so far since I've started investing in this portfolio here, I've been paid about over £2,000. And right now I am up about just over £2,000, and I did make another £4,000 or so on just selling different stocks and whatever over the years, right? And my expected dividend basically for this year is about £1,600. So monthly, basically on average, I'm getting about £135, which is a lot of money. Now, if you have a process, which is really what helped me in the last couple of years. When I first started, I was all over the place. I have absolutely no idea. I was buying stocks that I have no idea of. I was doing all sorts of things. But then, something clicked and I just started learning more about it, and I realized I have to have a process. I have to do these things such a way that it actually is. The markets are on, so sometimes that happens to the spreadsheet. But what I then realized I needed to do was this, okay? So right now, what I have is this watch list. Okay, so this is the example that I've shared with you guys. So what I tend to do is I don't buy stocks if I have not included them in here, right? I know exactly how much the stock will cost us right now, how much I'm willing to pay, what's margin of safety, and if it says a buy here, then I'll go away and do my research and see if I'm happy with the company. This process of knowing what to buy and when to buy has actually helped me a lot. And it's also helping me in terms of selling stocks that have basically not met the criteria that I set for myself. So the moral of this story, ladies and gents, is to be able to have a clear plan of what it is that you're after and what you're trying to do, because this week was a tough week for investors. A lot of people have basically I've spoken to are really worried about what might happen in the market. Is it going to be similar to what happened in 2008 or financial crisis, this and that? And again, it could be, but even if that was the case, I wouldn't be worried too much about these things, because I will start looking at my portfolio and say, okay, cool. Automatic data processing is actually down about 5%. Maybe next week I might look into it, add a bit more to it. Why? Because there's nothing wrong with this company. Nothing has happened to this company. It's down because the overall markets are down. Okay, some people are selling the index funds, for example, or they're selling the ETFs. When they do these things to go down with it, they might not sell the individual stocks, whatever, or they might even sell the entire thing, or because their ethos, basically their thesis have changed. Okay. So there's a lot of things that is happening around us, and we need to have a plan. We need to have a focus on what we want to do. And if you know exactly what you're buying and when you're buying and so on, then you really do not have to worry. Basically, you don't care, right? You look around and you say, do you know what? The markets are down today. What am I going to do? I'm going to go and buy some of the companies that actually are like in my that I want to add to my portfolio, or the ones that you've basically have. And that's what I've been doing. I mean, like I said to you in the last few weeks, I think I invested about £1,000 just this week. I'm planning to invest at least another 600 plus next week, and then max this before the 7th of April. So inshallah, that I just want to share with you guys that, because it's really important that we have a plan and we think about what we're doing in the long run. Now, the spreadsheets that I've shared with you guys, if you're interested, okay, you can get access to these things in here. Okay, so whatever tier you join, you'll find access to all of these things that I've shared with you guys, 9 of them. I will be adding more, inshallah, as the time comes. Inshallah, right now work is basically busy, so but alhamdulillah is a good busy. But inshallah, I will be adding to it more. And join us on the Discord as well. Some of you are having really good discussions there. I contribute as much as I can as well. So inshallah, we'll help each other grow this channel and help each other obviously become better investors, inshallah. Right, let's start with the two companies. So the first company I want to talk about today is the energy company. And oil companies or energy companies have done really well over the last few years. Okay, so in the last 15 years, when you look at the companies that have actually done well in the S&P 500, so this is the S&P 500 basically performance in the last 15 years. Okay, and when you look at energy companies, okay, you can see the worst time they've had it basically was minus 34%, almost 35% down in 1 year, and the best was basically 65%, almost to 66%. Okay, so annual return is about 4% and so on. There are obviously other sectors better than it, but last year and a year before, so 2021 and 2022, energy stocks have done absolutely amazing, right? This year, they actually, 2020 basically they're doing okay. They're not as bad as basically 2020, but they're not doing that great. So what I want to show you now is the company that we're going to talk about is EOG. And that company has been around for a long time. It's one of the companies that some of you have asked me recently to look at. So I just want to give you an overview. But before I did that, I want you to show you, obviously, the energy companies are doing really well. And a lot of people are saying, oh, okay, why are you not investing in energy and so on? But although they're doing really well, like when I highlight the green, if you see this bottom line here, look at that. These 3 years, okay, oil prices, basically oil did not do well. Okay, this year maybe about 12%, which is quite nice. Then 21%, minus 21, minus 8. So they are very cyclical. Okay, so that's the point that I'm trying to make here. So let's move on and let's look at these two companies today. So like I mentioned already, EOG Resources is the first company that we want to look at today. This company is basically explores for development, production, and markets crude oil and natural gases. They are based in the United States, but they do have other places like Trinidad and Tobago and so on. They work in these loads of different other countries. Currently trading $102 per share. They're down 20% for the year. Okay, the 5-year return is about 4%, because I remember last few years they didn't really do well. So I think that's catching up with them. And then EPS, we're looking at about $13.22, market cap of $60 billion. They have a narrow economic moat, and the beta is actually quite high. In terms of PE, the sector is very low, has a low PE, but these when you look at the current PE or the trailing PE and forward PE, both of them are very, very low. The 5-year average is about 20 PE, and then free cash flow, price to free cash flow, we're looking at just less than 10. So when you look at this, it doesn't really look basically that bad, but in comparison to the rest of the sector, it does look a little bit expensive. So we'll see what the other analysts actually think about this company. So it has a dividend yield of 3.14. The good thing about these oil companies, they do pay a nice dividend, and they actually are able to cover that dividends. And some investors actually just invest in them just for the dividend. Okay, so the latest increase is about 10%, which is really nice, and the 5-year growth rate of 36%. So 36% is basically on average what they've done in the last. They have increased in 36% in the last 5 years, which is quite nice. Payout, we're looking at about $3.30, and ex-dividend is 14th of April. They have increased this for the last 5 years, so that's probably why in here. Payout ratio to only 23, so very nice. So out of their net income, they're spending about 23% of their net income to actually pay investors. Dividend safety of 82%, and they have $6 billion in the bank right now. Free cash flow yield of 10% almost. Wow. I'm surprised that actually these companies, maybe some of the oil companies, they do actually have a high free cash flow yield, but there we go. So almost 10%, and profit margin 30%, operating margins of almost to 39%, return on equity 33%, total return in the last 10 years we're looking about almost 7%, and return on invested capital is about 26%. Revenue growth in terms of compounded annual growth rate of in the last 5 years, it's about 29%. And current ratio is above 1, which is really good. Now, next year they're expecting the earnings to grow about it's not going to grow minus 5%, right? And then 5% growth after basically the following 5 years. So according to Yahoo Finance, currently they are trading $101 per share, and according to Simply Wall Street, is actually overvalued. They expect the price to be 83, which I genuinely think that is the good price for this company. I think that's anything above that I think is overvalued, I'll be honest with you, because I have seen this company in the 70s and 80s for a long time, until 2020 came along, and basically oil prices went to the roof, and now the oil prices are coming down. That's why this company is down 20% for the year. Fairly valued according to it's 7% discounted according to Morningstar, 112. I think that's a bit too much, I'll be honest with you. Price target, because remember, you have to have a margin of safety, huge margin of safety for these type of companies, okay, because it's very cyclical, and obviously if you're in it for the dividend, you want to also buy it in in good time. So if it goes down, you can just hold it and forget about it kind of thing, and get your dividends, because the dividends are covered really nicely, but you also need to pay for it. Like maybe if it was 90 or 85, between 85 and 90, I think that would probably be better. Again, I'm giving you estimation, that's not financial advice, okay? Now looking at tip ranks, they're saying about 48% almost, 154. That's super bullish. I don't think that's the case. 151 according to Seeking Alpha, again 44% upside. I don't know about this. I think I'm more in between these two basically two. Okay, but according to Seeking Alpha, it is a buy right now. Sharia compliance side of things, there's no issues, and they have increased, by the way. They have not been buying back their own shares, so they have diluted the shares in 2021, maybe when it was too expensive, and now maybe they would wanted to use that money for something else. For whatever reason, they have diluted. They haven't been buying back since, so which is a little bit worrying. I don't like when companies do this unless they're using that money to finance for a deal, another company they're buying that's going to grow the revenue and help the company, basically all of that stuff. But for now, I think that's one of the things. Right, the next one I want to show you is in terms of the, according to Seeking Alpha, looking at their revenue. So it's growing nicely, and 2023 there is that drop. Okay, that's probably why the analysts are expecting minus 5% in terms of earnings, and then after that, will bounce back a little bit from 24 billion to 26 billion dollars. And looking at this as well, if we get rid of the estimates, you can see, wow, look at that EPS from $1.48 to almost $8. Wow, $8, and then it's gone up again for 13. So that's huge. But let's see the estimates for the next year. Okay, not bad at all. So it's heading the right directions. But yeah, that's the first company. The next one that we need to look at today is KLA. KLA is one of those companies I used to own in my portfolio. This company is in the semiconductor company. It operates through 4 segments: semiconductor process control, specialty semiconductors, process, display and components, and inspections, and all of that stuff. So they don't actually make the stuff. They have the technology, they have the equipment that basically these companies use. So in terms of current price, we're looking at $383 per share. Year to date is up by almost about 2%. 5-year return of 230%. If you own this company, had it in your portfolio in the last 5 years, you would have made over 230%. Okay, EPS about $24 right now. Market cap, we're looking about 53 billion. So it's not a really huge company. It has a wide economic moat, and beta slightly above 1. Now PE for the sector is right now is basically 29. PE for this company, we're looking at about 15. Let's call it 16. Forward PE of 20, and 5-year average PE is basically 18. And then price to free cash flow, looking about 17.5. Now, in terms of dividend, they're very small. Okay, they have a very small dividend, but it's well covered, 1.33%. Okay, latest increase was 24%, which is absolutely huge. The 5-year growth rate was 14%. They pay you $5.20 for every share of this company that you own. They've increased it for 12 years in a row. The payout is very low, and that's only 19%, which is really nice. Safety, 71%. They have about $3 billion in the bank, and their free cash flow yield, which is important to us, we're normally looking about 3%, is 5.6%, which is really good. In terms of profitability, in terms of profit margins, operating margins, return on equity, all of that is absolutely amazing. Last 10 years, the company made a return of 23%. Return on invested capital, we're looking at about 43%. Revenue, we're looking at about 21%. Current ratio, about 2.3, which is way higher than what we're looking for, which is 1 basically. Next year, they're expecting the earnings to grow about 15%. This year, and then basically after that they are expecting a little bit of decline, obviously, with this semiconductor companies. By the way, one of the things I want to say is these companies are very cyclical. So if the economy changes and everyone is now after buying new fridges, new this, whatever, these companies will start benefiting from that, and this will change. Okay, that's what you need to remember. So this can change within the next 2 years if the economy changes. If we are out of the recession, people start buying these technologies, then obviously there will be demand. When demand comes, obviously who supplies these companies, and they will make a lot of money out of that situation. So according to Simply Wall Street, it's overvalued about 8%. So their price target is 360. Right now it's 380. Okay. According to Morningstar, they're actually saying about 5% discounted. 410 is their price target. Okay. Mine would probably be in between. Okay. In between these two, probably 380-ish. Okay. Target price we're looking about for tip rank is 400 and almost 40. That's 12% upside. Again, similar thing for 137, 12% again upside. These two companies are very similar. I think they definitely use the same analyst there. It's a buy according to Seeking Alpha. Sharia compliance side of things is really good. Very low debt, and interest-bearing securities is absolutely fine. And they have been buying their own shares in the last few years. Right. Quickly looking at their revenue growth side of things in the next couple of years. So you can see it's heading in the right directions, and then it kind of drops off a little bit. That's why there is a little bit decline in their expectations, for example, estimates. And then when it comes to EPS, is heading the right direction. So there you have it. There's 2 different companies. Both of them are in a different sectors, whatever. Seem a little bit cheapest kind of thing right now. It's not undervalued, I will say, totally. Okay, but if you were interested, just then add them to your watch list and watch them until they get to the price target that you're comfortable with. Then obviously look into buying if that's what you want to do with those two stocks. I hope you enjoyed the video. I wasn't planning to make it this long, but obviously we had to have that discussion at the beginning. I hope you're enjoying the videos, and if you are, please like the video, subscribe to the channel. Let me know if you have any questions. Assalamu Alaikum. Enjoy your Friday.